understanding the basics of options trading. So before we get started, make sure to hit that like button and subscribe to my channel. Basics of options trading. The basics of options trading are mostly the same as the typical execution of trading other securities. You start with your thesis on a given asset, deciding whether its price will increase or decrease over a certain period of time. Then, you use your preferred trading platform to take your position in the relevant option. Here, however, is where the details of options trading comes into play. First, understand that options involve a contract between the buyer, or the holder, and the seller, or the writer. Much like engaging in a normal security transaction, there are two sides to a given contract, and they're essentially betting against each other. Buying an option involves paying a premium to the writer. This is just the price of the option itself. The writer of the option hopes to collect this without having to deliver on the option contract itself. The buyer of the option pays that premium with the assumption that they'll be able to execute an optimal market transaction. This is where, depending on the direction you choose in your thesis, increase or decrease, you can pick between a few option selections. Let's start with the two main types of options. Notice that we use precise language with options. Investors have the right to buy, which means they don't have to necessarily exercise this right. This isn't like the usual market order of buying or selling a security, where the investor is obligated to do so. This nuance is part of the strategy around trading options. Sometimes, it's in the best interest of the investor to choose not to exercise their option. Benefits and risks of options trading. Investors can use options to speculate on price movement with less principal and lower transaction costs, yet still have magnified returns. Of course, this is a highly idealized best-case scenario, but it can happen when an investor is careful and savvy. Options can be used to hedge portfolio positions. Hedging is when an investor enters a position solely meant to offset an existing position's potential risk. This is more common with institutions, but retail investors can still use this strategy to protect themselves from upside-downside risk. A greater degree of risk relative to other trading methods. In the same way that your gains can be amplified, your losses with options can also be much worse than expected. Depending on the approach, investors can even face unlimited losses. The complexity around options trading is much greater than typical market participation. Even the simplest pricing model for an option isn't necessarily easy to understand, and the degree of active management of open options positions is far greater than the more passive set-and-forget style of investing that most people understand. Long put strategy. A long put strategy is used when an investor is bearish on an asset, let's assume a stock, so they buy a put option to reflect this sentiment. Puts are also a common hedging instrument for investors holding long positions in the option's underlying security. For price speculation, a long put strategy is a less risky approach than short selling since this play requires less leverage and your losses are limited to what you paid for the option contract. To profit, the underlying asset needs to drop below the cost of the premium on or before the expiration date. Assume Company A is trading at $20 a share. A put option for Company A grants 100 of its shares at a strike price of $20. The premium for this option is $1.50, so the total premium costs would be $150. Note that put options tend to be pricier than call options, though not always. The investor holds this option until the expiration date, at which point Company A's share price has dropped to $10. The investor chooses to exercise their right to sell 100 Company A shares at the strike price of $20, an inflow of $2,000. The writer of the put option contract will then have to buy at this price of $2,000, even though the market price is $1,000. $10 hex 100. So in effect, the put investor is closing their position by buying Company A shares at $1,000, then selling those shares to the contract writer for $2,000. Assume Company A is trading at $11 a share. An investor is bullish, so they buy a call option at a strike price of $10 for $150 and sell a call option at a strike price of $14 for $50. At this point, the investor has experienced an outlay of $100, $150, $50. The investor's prediction pans out and Company A's share price rises to $15 at the time of expiration of both options. The intrinsic value of the bought call option is now $500, and the intrinsic value of the sold call option is now $100. The spread's value is now at $400, $500, $100. Factoring in the previous outlay of $100, the investor ends up with a profit of $300. If both calls would have expired out of the money, then the investor would have only lost their initial $100 outlay. Developing a trading plan. Set clear goals. What do you hope to accomplish? Recall that options trading grants a great deal of flexibility in how investors can manage their portfolios. It's this expansiveness and possibilities that can overwhelm investors, so start by establishing why you want to trade in the first place. This could include to speculate on asset prices, to protect your existing positions, or diversify your portfolio. Set entry and exit points. This could be done by placing strict buy and limit orders. But at a holistic level, investors can just track the intrinsic value of their options until they're above break-even. Generally, your entry point for an option play is when you're statistically confident that its underlying asset price is trending in your expected direction. Your exit point will be more straightforward, like when your option is in the money. However, sometimes you'll want to leave a position to prematurely avoid taking further losses, so bear in mind what strategy you're using and at what point your losses reach their maximum. How to place options trades. Placing an option trade is not unlike other security transactions. For this walkthrough, let's assume you're looking to speculate and have a generally bullish outlook on the market for the next 3 months. Assume you read this in September. Choosing the right option contract. Recall that typically, investors want to buy calls or sell puts if they're bullish and buy puts or sell calls when they're bearish. The expiration date will depend on the investor's timeline, by when their expected price movement should happen. And the strike price will depend on how much the investor is willing to risk for their expected upside. For our example, an SPY call that's at the money that expires in 3 months, when your bullish outlook is expected to end, would be sufficient. Placing a buy or sell order. A buy order would work in our scenario, since we're bullish and we're using a long call strategy. Typically, most investors, but especially new ones, will execute buy orders as part of trying to achieve a magnified return. Although selling options can work if you prefer this risk profile and would rather collect premiums instead. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to my channel for more content. Hit the notification bell to stay updated with my latest videos. Share your thoughts in the comments below. Thank you for watching.